Welcome. Today, we're exploring a topic that's fascinated people for centuries: gold. Whether you're a seasoned investor, a curious saver, or just someone interested in how the world works, gold has a story that touches us all. Today, we're diving into why gold matters to everyone, not just investors or treasure hunters. Gold is woven into the fabric of our financial lives, even if we don't realize it. Gold is a safe haven asset, meaning people flock to it when they're worried about the economy or their money losing value. In times of uncertainty, gold becomes a symbol of stability and trust. For thousands of years, gold has held its value, offering a sense of security you can actually hold in your hand. Civilizations have risen and fallen, but gold's allure has remained constant, making it a universal store of wealth. But gold's price isn't fixed. It reacts to real-world events, political shifts, economic news, and even the words of powerful financial leaders. Every headline, every policy change can send ripples through the gold market. Even if you don't own gold, the same forces that move its price affect your savings, retirement, and the broader economy. Gold acts as a mirror, reflecting the world's hopes and fears about money. In August 2025, a few words from the Federal Reserve Chair sent gold prices soaring, then dipping, showing just how connected everything is. The decisions of central banks and global leaders can change the value of gold in an instant. Understanding these moves is like a crash course in how money really works. It's not just about numbers, it's about psychology, trust, and the forces that shape our financial world. We'll break down why gold spiked, why it fell, and what it reveals about investor psychology. You'll see how emotions and expectations drive markets as much as facts and figures. By the end, you'll see how gold's story is really about confidence, fear, and the search for security. It's a journey that connects us all, no matter where we live or what we do. Let's get started and make you a smarter, more informed participant in your own financial life. The more you understand gold, the better you'll understand the world of money itself. Because when it comes to your money, knowledge truly is power. And gold is one of the best teachers you'll ever find. The spark for gold's wild ride came on August 22, 2025. A date that quickly became the focus of global financial headlines. On that day, Federal Reserve Chair Jerome Powell delivered a highly anticipated speech, one that investors, economists, and policymakers had been waiting for with bated breath. The Federal Reserve, often called the Fed, sets the main interest rate in the U.S., a decision that ripples out to affect everything from the cost of a new home mortgage to the rates businesses pay to borrow money for expansion. In his remarks, Powell hinted at the possibility of interest rate cuts, pointing to a cooling job market as evidence that the economy might need a boost. Lower rates can make borrowing cheaper, encouraging spending and investment. Rate cuts are like adrenaline for economic growth, so investors everywhere paid close attention, knowing that even a small change could have big consequences for markets. But Powell was careful not to sound too optimistic. He warned about sticky inflation, prices rising faster than the Fed wants, and highlighted the uncertainty created by potential trade tariffs and global supply chain disruptions. His message was mixed, a strong signal that a rate cut could come soon, but with no guarantees. The Fed was clearly watching the data closely, ready to act but not making promises. This blend of hope and caution set the stage for market volatility, as investors tried to interpret every word and nuance. Investors now faced a dilemma. Should they focus on the promise of lower rates and potential economic stimulus, or heed the warnings about persistent inflation and the risks from global trade tensions? Central bankers walk this tightrope every day, knowing that their words and decisions can move markets in an instant, affecting millions of people around the world. Powell's speech was a perfect example of how just a few carefully chosen sentences can ripple through the global financial system, shifting expectations and strategies overnight. The result? Investors scrambled to adjust their portfolios, and gold was the first asset to react, its price swinging wildly as traders tried to make sense of the Fed's message. Let's see how this played out in the gold market. Right after Powell's speech, gold prices jumped about 1%, a big move for a single day. Why? Lower interest rates make gold more attractive, since it doesn't pay interest, but also doesn't lose out to high-yield savings accounts. When rates fall, the opportunity cost of holding gold shrinks, so investors rush in. But by Monday, the excitement faded and gold dipped, giving back some gains. Why the reversal? investors realized lower rates could boost the economy, making stocks more appealing than safe haven gold. This shift from fear to optimism is called a risk-on attitude. Investors sold gold to buy stocks, chasing higher returns. The same news that lifted gold at first ended up fueling a move away from it. Gold's rally was short-lived, cut off by a wave of renewed risk-taking. It's a classic example of how quickly market sentiment can flip. 11. Let's look at the numbers. On August 25th, spot gold slipped 0.12% to $3,367.94 an ounce. Gold futures for December fell 0.2% to $3,411.70. Not huge drops, but enough to show momentum had stalled. Platinum fell harder, down 0.9% to $1,352.90 an ounce, showing investors were moving out of safe haven metals. Silver dropped 0.2% to $38.77, caught between its role as a safe asset and its industrial uses. The dip in all three metals showed investors were shifting away from safety and toward riskier bets. It wasn't panic, just a calculated move as optimism about the economy grew. Precious metals lost their shine, at least temporarily, as investors chased growth elsewhere. The numbers tell the story, a broad but measured retreat from safety. This is how quickly sentiment can change across the entire metals market. Let's see what else was moving. 12. Gold's price is tightly linked to the US dollar. When the dollar weakens, gold usually rises. Think of it as a seesaw. After Powell's hint at rate cuts, the dollar fell, making gold more attractive to global buyers. Tools like the CME Fed Watch showed the odds of a September rate cut jumped from 70% to over 84% after Powell's speech. This boosted gold at first, but soon, optimism about stocks overpowered the weaker dollar's support for gold. Investors decided the potential gains from equities were more appealing than gold's safety. This tug-of-war between currency moves and risk appetite is constant in the gold market. On this day, the desire for risk won out. Gold's fate was sealed not by one factor, but by the balance of many. That's the reality of modern markets. 12. Investor psychology drives everything. The markets are not just numbers and charts. They're a reflection of human emotion, fear, and hope. Every decision, every trade, is shaped by what people believe will happen next. Before Powell's speech, uncertainty made people cling to safe assets like gold. Investors were nervous, seeking shelter from the unknown, and gold's reputation as a safe haven shone brightest in those moments of doubt. But hints of a rate cut flipped the mood from cautious to optimistic, risk off to risk on. Suddenly, the fear that gripped the markets began to fade, replaced by a sense of opportunity and renewed confidence. Stocks rallied on Wall Street and in Asia, as investors shifted money from gold into equities. The appetite for risk returned, and markets surged as people chased higher returns. Gold's role as a safe haven became a weakness. When optimism returns, demand for safety drops. Investors no longer needed protection, they wanted growth. The very thing that makes gold valuable in bad times makes it less appealing in good times. Its shine fades when the world feels less threatening and more full of promise. This dynamic is always at play. Gold rises on fear, falls on greed. The cycle repeats as emotions swing from panic to euphoria and back again. The August 2025 episode was a textbook case of this shift. It showed how quickly sentiment can change and how fast money can move from one asset to another. Understanding this helps you see why gold's price can swing so quickly. It's not just about numbers. It's about the pulse of the market, the collective heartbeat of investors everywhere. It's not just about inflation or the dollar. It's about the collective mood of investors. When optimism surges, gold loses its luster, and when fear returns, it shines again. When confidence returns, gold takes a back seat. Investors look elsewhere for opportunity, leaving gold behind until the next wave of uncertainty. That's the push and pull at the heart of every gold rally and retreat. A constant dance between fear and greed, safety and risk that shapes the story of the markets. While gold and silver dipped, industrial metals like copper and nickel surged. These metals are essential for construction, electronics, and manufacturing, so their prices soar when economic optimism rises. Powell's rate cut hints promise cheaper loans and more building, boosting demand for these materials. Copper futures rose 0.4% in London and the US, A sign traders expected stronger global growth. Nickel, vital for stainless steel and EV batteries, climbed 0.5%. The contrast was clear. Risk-on sentiment hurt gold but powered industrial metals higher. When investors bet on growth, they buy the metals that build the future. Gold lost out, but copper and nickel thrived. It's a reminder that not all metals move together. Each tells its own story. 10. Meanwhile, iron ore prices spiked for a completely different reason. A supply shock. Rio Tinto halted production at a major mine in Guinea after a fatal accident, instantly tightening global supply. Steel mills, fearing shortages, scrambled to secure what they could, driving prices up fast. This had nothing to do with interest rates or investor mood, just the hard reality of supply and demand. It's a powerful reminder. Commodity prices are shaped by both financial news and real-world events. Each market has its own risks and triggers. One accident in Africa can ripple across the globe, independent of Wall Street. 8. So what's the takeaway from this whirlwind? Gold's price is shaped by a web of factors: Fed policy, the dollar, investor mood, and even distant supply shocks. We saw gold rise on rate cut hopes, then fall as optimism sent money into stocks. Industrial metals soared on growth bets, while iron ore spiked on a supply crisis. Looking ahead, keep your eyes on the Federal Reserve. Any change in inflation or jobs data could shift everything again. Watch the US dollar. Its strength or weakness will keep driving gold. And always pay attention to investor sentiment. Fear fuels gold, optimism fuels stocks and industrial metals. You can't predict the future, but you can be prepared. Stay informed, stay flexible, and you'll navigate whatever the markets throw your way. In personal finance, being prepared is more than half the battle. Thanks for watching. Now you know what really moves gold and why it matters to you. 13.